Hello, everyone, and welcome to the Currency Exchange, a NatWest Markets podcast series all about foreign exchange markets. And today we're going to be talking about Asia and China specifically. China is one of the main growth engines in the world, and recently we've seen some weakness in the Chinese currency. So we're going to talk about that. What's the outlook for China, and where do we go from here? And to help discuss that, I'm very happy to be joined by Galvin Chia, our EM Asia strategist out of Singapore. Thank you very much for joining, Galvin.
Hey, thanks for having me, Brian.
So maybe I can just start you off with a broad question here. I mentioned at the outset, the Chinese currency has been weakening. Dollar CNH is now decidedly above the 7.0 psychological level. What's going on here? What's been driving this weakness in the currency?
Yeah, I think that's a really good question. I feel like there's a couple of factors that have really just come together and sort of help push the currency back above this, psychological 7 levels you mentioned, right? So the first thing is, I think primarily, we're in an environment where the dollar is kind of creeping higher again. Markets are talking about the Fed again. Markets are talking about inflation. Now, the debt ceiling worries are done and dusted. Markets are thinking about, well, is U.S. growth, is the U.S. consumer doing a lot better than we had thought it was, right? And then I think, there's a couple of other things domestically that have helped engineer that push higher as well. I think the biggest one for me is this idea that there were these lofty expectations about the Chinese economy, the Chinese rebound coming into 2023. And I think that's really been brought down to earth pretty hard and pretty fast. I don't think it's necessarily a big growth revision, but I think it's the speed at which markets were disappointed by the recent data, the speed at which people had to pare back some of these expectations about how strong the consumer was going to be, how strong infrastructure or commodity demand is going to be. That's kind of helped fuel this disappointment, right? And I think the other sort of underlying simmering tension that's kind of we're probably going to see lingering around China for at least the next, I would say the next 6 to 12 months at the very least, is this idea of risk, whether it's geopolitical risk or operational risk. I think this is really key because we're in an environment globally for FX markets and financial markets more broadly, where geopolitics, politics is really going to be into matter, right? And I think in China, there are these lately, we've been having not just the ongoing, U.S.-China trade tensions, right, which have been a simmering theme since President Trump's presidency, but also this idea that in China they are cracking down as well in the name of national security. Now, be that as they may, it may be a legitimate concern, but it's also worrying a lot of a lot of foreign investors as to, what's the line that they shouldn't cross in China, right? So I think, all these sort of factors are sort of combining to produce this overall sense of cautiousness, right? And I think that, the one factor that fanned the flames there was, we had that dollar move a little bit higher and sort of markets the markets were primed already to view the Chinese economy and the Chinese currency kind of negatively, kind of bearishly, and that sort of helped it, push up above 7 pretty decidedly over the course of the last, couple of days and weeks.
I think it's important that you mention that there are two sides to this coin. Certainly, the dollar rebound, generally speaking, on the back of some better U.S. data and changing Fed expectations, has certainly been a part of this story. And it's interesting because it does feel like there's a bit of circularity here where the stronger Fed and stronger U.S. outlook weakening the CNH and weakening the Chinese currency, that's fed into a little bit to this market concern about global growth. If the Chinese currency is coming under pressure, what does that mean for the growth outlook? What does that mean for the growth outlook, not just for China, but for the rest of the world? China's reopening, I think, was a big macro story to start the year. And like you said, the recent data, particularly for April, have been very disappointing. So I want to ask you, which of the two sides of the trend do you think is right? Or do you think either of them is right? Do you think the market was overestimating Chinese growth coming into the reopening? So say the first 3 months, was that was that giving us too strong a signal? Or do you think maybe on the other side, are we overinterpreting some of the weakness that we've had in April?
Yeah, I think that's a really good question, Brian. I think that's a really central question that's going to be sort of important for the sort of US versus rest of the world outlook, but also for Asia and for China more specifically, right? I think I'd hate to say it, but it's kind of a bit of both. I think coming into this year, coming into this idea of the rebound and the recovery from COVID-0, you couldn't really put past the Chinese economy, right? Such a huge engine of growth that's been dampened for such a long time. Like you couldn't help but expect that there'd be a strong rebound. And I think in some particular sectors, and this is, I think, the key, that it's playing out in very particular sectors that makes it very difficult to translate into a sort of more abstract thing like the currency, right? Because you hear anecdotal stories about it being very difficult to get flights, that restaurants are packed, people are out, people are happy, hotels are full. But on the other hand, it's this idea that people aren't really having the confidence to spend on big ticket items, right? So auto sales has been disappointing. Property sales are picking back up again, but the pace of growth in prices or in the land transactions, those aren't quite as high as people had thought, right? And I think at the same time, there is this idea, like we've seen this so many times for the U.S. economy, in the UK economy, and in China, that the economics suggests that there is a multi-quarter kind of theme in the recovery, but the markets are demanding things over a multiple of weeks, not months. So like we sort of mentioned, it's this idea of the expectations part of the markets that I think have been severely disappointed, right? But at the same time, you mentioned the beginning of the year, these sort of broad expectations about China supporting global growth. I don't think being in Asia and looking at the Chinese rebound, it was never to me that obvious that it would be, a frenzy of the Chinese buying copper, the frenzy of Chinese buying steel, or, importing everything, right? It was always somewhere a little bit less than that. So I think, there is an element of the world or sort of foreign investors, particularly using that old playbook of, they're going to stimulate everything, they're going to build bridges to nowhere, and it's going to be this next commodities super cycle, right? So it was kind of somewhere in between on that. But I think, yeah, like you mentioned, this sort of crash in expectations has just seemed to come particularly hard and fast at a time where the Fed expectations starting to ramp up a little bit again.
I think it's really interesting the way you categorize that. This feels much more services led in terms of the reopening being a services style led recovery as opposed to a manufacturing or building or construction led recovery, which I think we've become so used to from China, that the manufacturing cycle, that the external facing economy, building materials to export to other economies, that's been the big driver of Chinese growth. And now it feels like it's a bit of a different story. So like you said, you sort of touched on this, but I'd love for you to expand on it. China as an inflationary engine for the rest of the world. You've never really seen that this China recovery was going to be a big inflationary moment. And certainly I would imagine that the recent slowing in data has probably reinforced your view here.
Yeah, absolutely. So, I mean, we were talking about this in March, and definitely other sort of economist circles were also at that point in time, assessing the fact that, this was going to be primarily service or consumer-led rather than a credit-led, infrastructure-led thing. The authorities, especially the PBOC, have always been very wary about this debt overhang that's been plaguing China since the last credit-fueled cycle. And they've always talked about being a little bit more cautious, right? So to us, it was always, a matter that this was trying to be consumer-led. And I guess for us, the question was, how broad was that going to be, right? So I think this assumption or this heuristic, this bias that the rest of the world has been thinking about, that, this would be an old-style recovery, is something that has stuck, over the last, I don't know, what is it now, like 8 years or something, right? But I think at the same time, we may start to see elements of an old style economy start to emerge as well, particularly, if we see the consumer not being particularly strong. Does that mean that state-owned enterprises, are coming back to the fore? I mean, you also mentioned very interestingly that, China previously being this exports economy, actually Chinese exports continue to do incredibly well. The last trade numbers, I think for the April month, saw a $90 billion monthly surplus, right? And that's the highest, that's still post-COVID highs, that's still, record highs. So in terms of the surplus that the Chinese data is showing, that's actually still very much in the driving seat, I think, at this point in time.
So I want to ask you about the response from authorities in China, specific to slowing growth. you have only seen 1 month of slowing. And as you mentioned, there is a desire to not, fuel a credit cycle, fuel a credit boom, one that really hurts long-term imbalances. Is that something you think is going to hang over near-term decisions? So, we have only seen 1 month of slowing, but the market is already really clamoring for additional easing, whether it come from fiscal side or from the monetary side. I think you put it best earlier, where the market thinks very short term, but if there's one economy that I feel like it's always thinking long term, it's the Chinese economy. And so, where do you think policymakers fall in terms of stimulus? Well, do you think that there's a moment here where growth has slowed enough that China's going to try and step in from the stimulus side, or you think it's going to be more targeted and maybe slower than the market hopes?
Yeah, absolutely. That's a critical question as well, right? I think at this point in time, it's very difficult to see a huge reason why, a compelling reason why the authorities should, come in all guns blazing and throw in the kitchen sink as well, right? I mean, the one easy metric that, I believe we might have discussed before in our conversations is, the growth estimates, right? So let's say growth expectations from a market kind of point of view, you look at what the other economists are saying. That was maybe earlier this year, they were probably looking at around 5.8% for 2023 for the full year. Now, I think after the recent set of data, that's probably been pared back a little bit. Let's put it at 5.25, right? So let's say 5.8, 5.75 pared back to 5.25. That's compared to a GDP target that they've been setting for this year, 5%. So I think, regardless, the way it's going, and we are still, halfway through the year, right? The way it's been going, it isn't looking catastrophically bad. So, if you say you want to play it prudent, you want to play it conservative, that's not really reason to ease big time just yet, right? And if anything, the PBOC, Governor Yi Gang, has made it abundantly clear, very interestingly, in both Chinese and in English, in a speech he gave in April, I believe, in Washington, D.C., that he was saying that, the central bank this time is really going to play it under his authority. The central bank is going to be very conservative and very prudent on what they're going to do. So to me, I think that sounds a lot like, they might tweak here and there. They might try to maybe increase some of the liquidity in the banking system, but it's not going to be something like, again, they're not going to be building empty cities, and they're not going to be building bridges to nowhere. So it's really, I think, something about, calibrating these market expectations, fine tuning these market expectations.
It certainly sounds like the Western playbook of when growth is low and growth weakens, and amid an environment where inflation in China has been relatively contained, the market's always looking for the next dose of stimulus. But in this case, it looks like that just might not be coming. And I mean, you mentioned a really good point, thinking back to when the Chinese government set their growth, sort of the growth targets for this year, that came in well below where the market was expecting. And, we were talking about that at the time as something that said, maybe that the officials would be willing to tolerate a slowdown in growth if it were to come, if the growth in China were to maybe miss versus expectations a little bit. And it certainly seems like that's playing out now. And I do want to turn to the PBOC now, because we know that, the Chinese authorities, certainly have a history of managing the currency and trying to lean against weakness, whether that be by encouraging changes to the way that the dollar CNY fixes, or via outright intervention. But it seems like aside from what you might call verbal interventions, where the PBOC governor came out and said, we will try and curb speculation in the currency, that seems like, that shot across the bow feels like it's the only thing that feels like it's been the only response from officials so far. Do you think that continues? Do you think the authorities are going to be willing to step up more directly to try and limit the currency weakness that we've seen as a result of some of this softer data?
Yeah, I think it's going to be difficult to say what the authorities won't do. I definitely think that they'll reserve that option, as all central banks did, last year, of potentially, intervening, not necessarily directly, but perhaps through some of their the state-owned banks. But I think what we've seen, throughout the course of last year and this year, is that the 7 level, where previously was very significant and was, the sort of do or die last stand kind of line in the sand, it's not been that anymore. We broke past 7 in, I think, Q3 last year, and came down again, and we're back up above 7 again. And so far, it seems like the PBOC is really willing to let at least the currency markets fluctuate according to supply and demand. Now, I think there will be points in time whereby, as you mentioned, this verbal intervention happened, and that probably happened when the move up towards 7 was happening especially quick. But other than that, I think the regime for central banks, PBOC included, is to perhaps try to slow the direction of travel, but not try to reverse it entirely. They learned a very costly lesson in sort of the mid 2010s, and I think that they're pretty set on not repeating that one again.
Yeah, it certainly sounds like that slowing volatility, slowing the directional move is probably more important or perhaps more palatable than picking a specific level in the sand and saying this is a level beyond which we don't want the currency to move. And I think that makes a lot of sense. You think, the currency traditionally as a bit of a growth release valve, a pressure release valve for the economy, that when the economy slows and the currency weakens, that obviously has some potential positive growth benefits from the export side. And that in itself is a bit of stimulus. So if you think about the currency as a release valve, I think it makes some sense to allow, to not be leaning so hard against currency weakness that comes for what I would consider fundamental reasons. You mentioned the dollar has been rallying against a lot of currencies. The Chinese currency is not the only one that's been weakening against the dollar recently, though it is obviously one of the very notable ones.
Absolutely.
I do want to turn to another economy in your region. You're not just a China specialist. You are covering the entirety of emerging markets, Asia. Talk about one of the other major global economies, and that is India. India is almost a bit of a counterpoint to China in some ways. I want to ask, what's sort of the big themes in India right now, and how are you thinking about the growth in India?
Yeah, I think, this idea of the counterpoint, I think is a really good point, because I think, if you sort of step back and abstract a little bit, there's a lot of things that are kind of almost, on the opposite side of what's been happening in China. Indian growth over the course of the last fiscal year has actually, that number printed recently, it came in at 7.2% year on year. And I mean, compared to China's target of 5, right? Like, sort of mathematically, India technically would be the one that is lifting global growth, not China, right? So I think that's a pretty incredible point. Over the last couple of months, I believe India's population actually exceeded that of China finally. So it's now the most populous country, according to some estimates, in the world. We talked just now about the PBOC wanting to sort of let the renminbi kind of almost free float. Currently, the Reserve Bank of India is actually managing the dollar INR, the dollar rupee across very tight levels between 81 and 83, which actually makes it a very interesting and very good sort of risk-off hedge, the way we see it in the region. And whilst Chinese inflation is low and interest rates very, very low, which makes it, I guess, a very good candidate to use as a funding currency or to be a short. Indian policy rates are in the realm of 6.5%, which makes it a very, very good sort of reasonably high carry expression in the region, right? So on that sort of from the market and from the economic side, India's a high growth country now, kind of higher inflation, but also high carry, right? And with the currency a little bit more managed in recent months, which I think makes it a good, when the dollar is appreciating, right? The Indian rupee actually has stability, so it's actually a kind of relatively a good currency to be, let's say, invested in versus the other ones.
I do want to ask you about geopolitics as relates to both of these economies, because both of these economies, India, I think especially, seems to be trying to be on both sides in terms of their relationship with Russia and their relationship with with Western economies. You've seen recently some weakness in the South African rand as South Africa's relationship with Russia has really sort of moved from the back page onto the front page as a near-term theme for markets. And we know that the geopolitical story between the US and China, the tensions there, like you said, going all the way back to the trade war and even beyond, has been something simmering over these, the US-China relationship and the China recovery. And one of the things you mentioned when you spoke about China was international investment into China and potential risks there. We know that for India, investment into that economy, foreign investment into the economy, particularly I think the equity market, is an important driver of growth there. How are you thinking about geopolitics in these economies?
Yeah, that's a really good question. I think, this word that you use, the counterpoint, is probably a good one. So, it's a good counterpoint because India is, let's face it, part of the Quad, right? Part of this US alliance that's supposed to have a very strong presence in the Asia Pacific region. And in some respects, as a counter to China, right? India is a member of them. But like you said as well, the fact that India has been a very, very large customer of Russian oil, actually, that's one of the major reasons that India's historical trade deficit, and which was historically large after COVID, after the lockdowns, has been able to shrink very rapidly. Is because they've been able to buy out this Russian oil, and that's really helped reduce their oil import bill. Even as the economy was growing, their oil costs have actually shrunk. Right, so I think that's been definitely one of the big factors in getting sort of international investors interested and excited in the Indian rupee. Right, equity markets are growing very well, and manufacturing is also doing quite well. Manufacturing is still a very small part of the Indian economy. Let's face it. But there are lots of high-profile stories, lots of feel-good stories, because you have international supply chains, multinationals that are concerned about their exposures to China. Too many eggs in one basket, if you will. That are diversifying their supply chains to India. One very, very large multinational electronics manufacturer actually started manufacturing and assembling in India, which I think has been the big win for not only Indian equities, but this idea that India can be an alternative manufacturing and assembly hub in the region, right? So in that sense, it's been able to really play its sort of non-aligned status, to go back to that sort of old terminology, but it's been able to play its non-aligned status really to its advantage by courting both Western supply chains and by benefiting from cheap Russian oil.
I do think the idea of friendshoring is sort of a broader concept. I don't think we should be sleeping on India as a potential beneficiary there. Certainly here in the U.S., we talk a lot about the benefits that Mexico could see, for example, just from its proximity. But I think there's also going to be looking around within the region, sort of outside of China, when there's an opportunity to reposition what economies are well suited for that. And I think India is in a pretty good spot from that perspective as well. So with that, I think we will stop it here. Thank you very much, Galvin, for joining. And thank you very much for listening, everyone. If you liked this episode, please be sure to hit the like button and to subscribe to our channel so that you can see the latest episodes when they're released. Thank you very much.